Welcome to Market Call. Mike Philbrick is on our show today. He is CEO of Resolve Asset Management, and he's taking your questions on exchange-traded funds. Call us toll-free 1-855-326-6266 or send an email to marketcall@bnnbloomberg.ca. When you can, when you're calling in, just say on air the ticker symbol and the name of the ETF, if at all possible. You can look it up. Just type in the symbol for the ETF into Google and then just go Yahoo Finance. That's one quick way of doing it, finding the actual name. Mike, thank you very much indeed for joining us. You've got a phrase here: a wall of worry, a mountain of opportunity. So is that your feeling on the markets right now?
Precisely, Andrew. I think markets continue to climb proverbial walls of worry. And I think this has got to be one of the most hated rallies of all time. You know, since 2019, we've faced a global pandemic, a war, inflation spikes, rate hikes, tariff tantrums, widespread geopolitical instability, and yet global economies remain resilient and robust, and investors are reluctant to embrace this rally. It's a bit strange.
I suppose our friends, it's vitamin T, the tariffs people are worried about.
Yeah, in particular in Canada, that tariff word is hitting home. We believe that skepticism is misplaced, right? There's underappreciated tailwinds in our view. You've got strong household and corporate balance sheets. You've got the potential for a pivot to a dovish monetary policy. These things could surprise on the upside. We're starting to see the tariffs work their way through to negotiations, so that bit of lack of clarity is being cleared up. And then you layer on top of that the accelerating impact of artificial intelligence, which both can increase productivity and exert a deflationary force across industries. And the long-term case for growth becomes pretty compelling. And we think that, the odds of a recession are overstated. And then I'll give you one last fact. On top of that, you've got pretty unprecedented amounts of money market funds sitting on the sidelines. In Canada, this is true. And in the US, there's $7 trillion on the sidelines. Now, it's there to get that yield. But if yields were to drift lower, those assets are going to start to stampede into risk on assets rather than risk off assets. And this is where we think that most people are under anticipating the right tail risk, the opportunity for actually things to work out better than they expect. And this is an under-owned bull market.
An under-owned bull market with trillions sitting in money market funds.
Correct. So when you line all these things up, if things start to resolve positively, it would seem that many investors are underexposed. And this market has been a lockout market. It has not let people get in. The pullbacks have been very short and have prevented folks from sort of buying the dip, if you will. We see this as, something that's probably going to continue.
Mike, we got to take a break. It's great having you here to talk about exchange-traded funds. Please phone in or email in your questions on exchange-traded funds. If possible, include the symbol for the ETF and also its official name. Just type into Google ETF and the symbol, and you should be able to get the name very quickly. Thanks very much indeed, because it is confusing. These things proliferate. We'll be right back. We have an email here from Doug. Please give me your thoughts on the Hamilton UMAX and HMAX funds. Doug says they are paying pretty high dividends, north of 13%.
That they are. And this is something where I want to just talk about the fact that yield does not equal total return. So if we step back and say, well, let's look at HMAX, the Canadian Financials Yield Maximizer ETF. 70% exposure to the big six banks. They do a covered writing on that. And remember, covered writing works in sideways to slightly uptrending, slightly downtrending markets, but it does sacrifice upside. And let me give you an example. So if we look at HMAX over the last 12 months, it's up 23%. That's inclusive of those dividends. But if we step back and say, well, what was the cost of writing those options? And we look at ZEB, the BMO Equal Weight Bank ETF, that's up 33%. That's a 10% difference on upside that the covered writers have given away because of the way call writing works, right? When you sell those calls, you take in some income today, but you give up that upside. And UMAX is very similar. If we look at UMAX, that's the utilities yield maximizer. And if we compare that to the iShares TSX Cap Utilities Index, that index is up 21%, where UMAX is only up 7%. This is because of the lower volatility in utilities. You have to write tighter options, so closer to where the price is today. And that forgoes more of that upside. So just to be clear, the yields are there, they're wonderful, but there is a give up. So these are really not for growth-oriented investors. These are really for more income-focused investors. And you are sacrificing some upside. So what you might want to do is blend some of these ETFs we've talked about, where you're getting a nice yield from the Hamilton products, but also keeping some of the upside by using maybe some of the other products that don't write the covered rights so aggressively. Now, that's up to the investor's preference, but that's a pretty common theme across all covered writing ETFs. This is not exclusive to the UMAX and HMAX products.
Yeah, these numbers are quite striking. So I'm looking at HMAX, which tracks the financials. Total return over 1 year of about 23%. Whereas ZEB, that BMO ETF, Equal Weight Bank, is a total return of 33%. And then the difference on the utilities is really big. UMAX total return of just under 7% over 1 year total return. But the darn utilities index has given you a return of just over 20%. So certainly on a total return basis, these two have underperformed over 1 year. I didn't realize.
As I said, if your priority is income, then the covered writing strategies can make some sense, but maybe own both.
Okay. We have Chad in Vancouver. Go ahead, please.
Hi, Andrew. Hi, Mike. My question is about defense ETFs. I don't know if I'm a bit late in considering buying any of these, particularly SHIELD, SHLD.
Okay. Thank you very much.
Yeah, I think you're not late at all. And this is a sector that I really, really like. How can you not like AI, war, aerospace, and cyber all in one? So the SHLD ETF that you're talking about, that Global X Defense Tech Index ETF, that does trade in the U.S. It's listed in the U.S. and the fee is 50 basis points. The top holding is Palantir. And Palantir has been the true market leader of this market, and it's, AI and war. And that area probably stands to benefit, continue to benefit as we move forward. Now, it's probably not something that you're going to put all of your portfolio in. You want to have this is more of an explore piece of the portfolio. But yeah, this sector is pretty bullish. And it's been one of those lockout sectors where pullbacks are few and far between. So gaining a position can be tricky, but start small and maybe build the position as it becomes profitable for you.
Okay, yeah, I see that. We don't have the chart, sorry, but that SHLD up more than 70% in the past year. We have Justin in Calgary. Go ahead, please.
Yes, good morning. Andy, I've been watching since '99, and I thought it's about time that I call in.
Oh, you took your time. Okay, thanks.
My question for Mike today is on HBA, which is the Australia Equal Weight Banks ETF, and just wondering if Australia is a good place to put some money. Thank you.
Yeah, I think this is a very interesting play, actually, off the beaten path a little bit. But here we have very much like, as I spoke at the beginning about the potential for this bull market to be bigger than we might expect. And one of my top picks is also getting out of the U.S. A lot of people are focused on U.S. markets. And what we see is in globally, we see a lot of the rest of the world outperforming the US. We've seen that in Canada over the last year as well. The interesting thing with Australia, very much like Canada, in that it's a resource-based economy. And in a resource-based economy, you should see a bigger uptake if everything goes as we might expect, i.e. there's a little bit more growth, there's a little bit more demand for commodities, there's a little bit more oomph in economies that are based in resources like Canada and like Australia, and you're getting those large Australian banks that are going to be networked throughout the entire economy. I think it's not a bad idea, and it's an interesting play for diversification globally.
The Australians, they just had, they tried to launch their first missile into orbit and it failed seconds after it launched. Somebody on Twitter said there would have been a control room full of sunburned people all going, oh no. Anyway.
Chewing on those vowels.
Yeah, but I'm sure the Aussies will have another go. JP is in Edmonton. Fire ahead, JP, please.
Hey, thanks for taking my call.
Pleasure.
My question was on YieldMax ETFs, specifically the MSTY, ULTY, and NVDY, if there's any familiarity on those, and just the medium and long-term outlook if you have any. So I'll hang up and listen to your answer. Thanks again.
Thanks a lot.
Right. And so these are a series of ETFs that have come out and are, a single stock, high income, covered writing types of. These are the MSTY is the Harvest MicroStrategy High Income Shares ETF. And so the challenge with these is you've got a single stock, you're writing some covered rights on it, so you're going to see probably some pretty good yield for these. These have been mimicked in Canada as being launched in the US. And you mentioned some other names. NVDH is the NVIDIA version. There's an Amazon version. The challenge with these in the Canadian versions is they are pretty small at the moment. So there's not a lot of assets in them. And it's a single stock, long type of investment, and you covered writing it. So it's going to have some volatility, that's for sure. So I would say these are on the much higher risk spectrum than most. But if you were going to own MicroStrategy anyway, I suppose having covered right on it would provide some income in the short term. Again, that's going to be taxable to you, whereas if you just own the stock, you don't necessarily have to take those gains on a regular basis.
We're going to take a break. Mike Philbrick of Resolve Asset Management is answering your questions on exchange-traded funds. Mike Philbrick is taking your questions today on exchange-traded funds. We want to hear from you. 1-855-326-6266. Control room, do we have somebody on the line? Joe in Montreal. Go ahead, please.
Yes, I want to ask Mike about the Harvest Tech Achievers ETF, HTA. I have it in both my cash account and my TFSA. Had it for several years and retired. I wanted Mike's opinion on this, and if I've done well with it, if I should be taking some gains here or just let it ride. Thank you.
Thank you.
Right, so this is the, as you said, it's the Tech Achievers. So it's core U.S. large cap dominated, and it's the 20 largest capitalization stocks. So very, very large cap in its features. It also offers that covered writing, I believe, that we've been talking about, because it's the Achievers Growth and Income ETF. Covered call strategy to enhance the portfolio income. So you've got that potential for limiting a little bit of the upside. And the more income you take, the more you limit the upside of that industry and sector. But if you're looking for exposure to those very large companies, from Google to Oracle to NVIDIA, Meta, Apple, then this is giving it to you. I think the future here looks great. I wouldn't see any issues in those stocks. Again, do you need all of the income, because you are giving up some upside in that by covered writing? But I think we've covered that today. Don't see any issues with it. Again, management fee is 85 basis points, so that's a little bit more than you'd be paying on just a straight ETF and Tech Achievers, but you're getting the covered right as well. And just be careful about having too much. That's all.
Let's head to Calgary. Devesh, go ahead, please.
Thank you. Thank you for taking my call. Investment in ETFs that track the S&P 500, like a US ETF VO, SPY has a lower MER, that is 0.03, and Canadian ETFs like VET has a high MER, 0.08. Which one is better in the long run, considering the factor like a currency exchange rate and taxation? And also, if you can please suggest one from the US and one from the Canadian side in the current all-time high scenarios. Thank you.
Thanks.
Okay, I wasn't sure what sector he wanted on the Canadian and U.S. side. So there's a lot to talk about here. In the Canadian world of ETFs, unless it's a corporate class structured ETF, they will distribute the income and capital gains every year. In the U.S., there's a different tax structure where if you've been in a U.S. ETF, they kind of wash those gains out through market making, and you don't get the capital gains distributions. So that is an advantage, probably not a very well understood advantage that Canadians have by buying a US ETF. Now, in Canada, the corporate classes tend to do the same thing. So if you look at Global X, they have some US ETFs that are in the corporate class, where you're not going to get the distribution of the capital gains. What happens is your unit value grows, and then upon sale, you're going to have to report that capital gain. The other thing that comes into a question here, though, is there's some estate issues. If your estate is very large, owning U.S. securities can subject you to some strange estate law rules, but the estate has to be pretty large to do that. So there's a few things to consider there, and as you know, many times the fees of the U.S. ETFs are lower, but that's not always the case now. They're not much lower. So we looked at the Vanguard S&P 500 Index VFV in Canada. That's 9 basis points. Now I know in the U.S. we're approaching free, and 1 to 2 basis points, but it's a pretty de minimis difference in the fee. So and I wasn't sure what the caller wanted from the standpoint of a pick. Actually, I don't know if you got that, Andrew.
Okay, let's squeeze in one more caller, Kevin in Toronto.
Sorry about that.
Sorry, I cut you off there, Mike. I beg your pardon.
No.
Let's squeeze in one more caller. Kevin in Toronto.
Hi, thanks for taking my call. Mike, I'm looking at HNU. It's pretty volatile. I've traded it twice, and I consider myself lucky. Do you see natural gas dropping further seasonally? Thank you.
Thanks very much.
Well, yeah. So let's. HNU is the I guess it's still the Beta Pro natural gas levered ETF. So you're getting a double exposure to the natural gas market, and as a comparison with volatility. So stocks, if you looked at Canadian stocks or U.S. stocks, they tend to have a volatility of about 15%. The volatility of natural gas is in the range of 80%. So this is a wild monster to try and have to deal with. I would be somewhat. I'm sort of a little bit bearish on energy, actually, and that is because of the stated objective from the U.S. government in pumping oil and natural gas and hydrocarbons in order to lubricate the economy and the growth of the economy. So I think there's going to be a lot more production that comes online, which is going to be challenging for price increases. So, I would be very careful. I think the spikes upward are going to be sort of cyclical spikes, and the secular pricing is going to be, lower. And that's been sort of engineered by our good friends to the south, who want to make sure that we've got lots of energy to do all the things we need to do. Now, Contrary to that, I'll give you the other side, we've got lots of AI power demand. And so, in a longer term, maybe we could see so much demand that we start to see these prices get up off the floor. But at the moment, I would say there's going to be a lot of supply coming to the market that's probably going to hamper the upside in natural gas.
Okay, we are going to take a quick break. We will check out Mike's past picks when we return. Mike was on our show August 30th of last year, and his first idea was a gold bullion ETF, CGL.C. Of course, gold has rallied and has shot higher, hitting record highs over the past year. Would you stick with this idea?
Absolutely. You'll have to pry my gold from my dead hands. So yes, I think the story for gold has gotten stronger, actually. Over the last several years, we've seen central banks buying 1,000 tons of gold a year. That is up significantly from previous to the Russian invasion into Ukraine. And this fragile geopolitical landscape lends itself to owning gold as a diversifier in your portfolio. You've got that potential US dollar weakness, which also is a tailwind, and this persistent central bank buying, which is becoming, again, a foundational reserve asset. So gold remains a strategic diversifier, and we'll talk a little bit more about some other ways you can invest in gold in the top picks.
Okay, you're going to have another gold idea. Let's have a look at how the next one did. TQSM, it's a TD US Small Mid-Cap Equity. And of course, those small and mid-cap fund or stocks have been left behind by the tech giants.
They sure have, and it was me being early. So this particular ETF uses quantitative rules-based approach to provide exposure to U.S. small and mid-cap equities. And so what we're waiting for here is the market to broaden out. And if we see this, the tariff tantrum subsiding and the Federal Reserve eases, so higher interest rates are really deleterious to those smaller and mid-cap companies. They're really impacted by funding requirements. But if we get that easing, it's likely that the market widens out and you start to see these small and mid-cap growth companies really catch up. You've also got this AI wave that's coming across these small and mid-sized companies, which also is going to provide productivity boosts. So I would stick with this one. We were early last year, but I think as we go through the next year or so, you're going to see a broadening out of the market into the smaller and mid-cap names.
Okay, and then finally, this is the IMGB DBI Managed Future Strategy ETF. This one underperforming over the past year.
Absolutely. And a friend of mine, Brian Portner, likes to say, diversification is always having to say you're sorry. So this fund replicates leading managed futures hedge fund managers. And this is a diversifier to the portfolio. So often we'll do well, like in times like 2022, when things were really rough for equity and bond markets, this did quite well. Now, the challenge is trying to hold on to these underperformers when they're underperforming in your portfolio, so you have them when the inevitable declines in equity or bond markets occur. Now, having this funding issue where you're going to sell your stocks to buy the DBMF, as an example, is a challenge, and that's something that we take pride in doing return stacking. So you don't always have to just simply sell something that you know, love, and trust in your portfolio to buy a diversifier. You can layer it on top, and that's called return stacking. So that's a way to attenuate the behavioral bias of always giving up on these diversifying strategies because they underperform, which they will do from time to time.
We are going to take a break. Mike Philbrick of Resolve Asset Management taking your questions on exchange-traded funds. Jeff is calling from Toronto. Go ahead, Jeff, please.
Yeah, hi. I'm a senior citizen, and I'm looking for two different types of ETFs. One is a relatively high dividend payer for income, and the other is a dividend grower for inflation protection. Okay, thanks very much.
Great, and a good question. I think that the difference between, let's say, looking for an ETF that's looking at those growers versus one that's just looking at the high yields there is the ones that are looking at growers are going to look at things like really strong fundamentals based on return on equity and dividend yield and free cash flow. And other things are going to look for long histories of being able to demonstrate that through many market ups and downs. And so versus the high payers are probably going to be just looking at market capitalization and screening for what's paying the highest dividend. And they're going to have less of a concern for the quality side. Now, I'm going to caveat this is you're looking for a dividend ETF. So I'm not including the covered writing things because those are not actually corporate dividends. Those are capital gain distributions. But let's get to a couple examples. VDY, Vanguard's Canadian High Dividend Yield Index. ETF. So here, this is going to track the performance of those Canadian companies with those high dividends. MER is about 0.22 and the dividend yield's about 4 or 5%. And they're not really prioritizing that dividend growth. Conversely, if we look at XDIV, the iShares Canadian Select Dividend Index, this one is looking at those dividend growers. So they're going to look at dividend sustainability and they're going to look at growth metrics and they're going to look at the market through that lens in order to provide more growth of those future dividends. That MER is 0.10, so 10 basis points. And you'll notice the dividend yield's a little lower, 3 to 4% approximately. And that's because it's prioritizing not the actual current income, but the forward-looking growth of those dividends from the companies in the ETF.
Okay. Thanks very much. Stephen Vaughan, Ontario. Go ahead, please.
Hi. Thank you for taking my call.
Pleasure.
I just wanted to ask the gentleman about an ETF, healthcare ETF, that would be diversified in terms of not only the companies that were included, but also in the various subsectors within the genre of healthcare. Not just the drugs, services provided, maybe medical materials, etc. Wondered if he could give me some suggestions on that.
Thanks.
Okay, that's a good question. I would tend to look at the iShares Global Healthcare Index ETF. That one is HXC, and it's tracking the S&P 1200 Global Healthcare Index. So you've got holdings by large diversified pharmaceutical, biotech,
and sorry,
medical
Phil,
device.
What was the symbol on that one again? Sorry.
Oh, XHC.
Okay, carry on. Sorry. Okay.
Yeah, iShares Global Healthcare ETF. And it's tracking the S&P Global 1200 Healthcare Sector Index. So as the caller requested, looking for things with everything, if you will, pharmaceutical, biotech, medical device, health services. Major holdings include things like Johnson & Johnson, United Healthcare, Pfizer, that sort of thing. And so, healthcare is often a defensive sector as well, and you've got the tailwind of an aging population. But that one is very broad-ranging and has a giant scope, if you will.
That one, we can see it's down in the past year. I'm just trying to check its holdings. I'm guessing that it's been hurt. I'm just trying to see, has it been hurt by the drop in United Health, for example, because that has been such a disappointment for investors.
Yeah. Yeah, and some of there was that Ozempic craze for a little while. Some of those stocks have pulled back. But yeah, the holdings are, just looking them up. So you've got
Eli Lilly, Johnson & Johnson.
Yeah.
United Health is pretty big in there. Yeah.
Yeah.
And I guess even those, even Lilly, which is seen as a winner in the weight drug space versus Novo Nordisk at the moment, that stock has come off its highs.
Oh, yeah. I mean, Lilly's down 4% for the year. So, again, the caller may be looking at this sector because it has been a little bit, it's languished and it's trailing. And so maybe it catches up. It also acts as a bit of a defensive sector. So remember that we're in a rotation towards high beta and high growth. When we get into that type of situation, money rotates out of those more defensive sectors. And so, notwithstanding some of the idiosyncratic risk of United Health, you're also going to get those money flows moving into the more risk-on type of areas of the market.
Thank you very much indeed for that. Joe in Mississauga, Ontario, thanks very much.
Thank you for taking my call. I was asking about GDXJ. I had also planned to ask about what Mike's macro view on gold was, although he's clearly stated that in his past picks. Whether that, in light of his macro assessment at the beginning of the show, whether he still thought gold was a play, and he obviously does. So GDXJ, but I also wanted to ask Mike, if I could, about his views on silver as well. In the context of GDXJ, a lot of people that I follow are saying, silver is due for a catch-up trade, and some people are calling for much higher silver prices. So thank you very much for taking my call.
And this is the VanEck Global Junior Gold Players.
Right. And this one is a U.S. ETF, so it trades in the U.S. MER is about 51 basis points. And so we're at an interesting inflection point. And in my top picks, I've also got a gold ETF. What's interesting is when you're looking at the gold market, you want to buy the physical metal for the first leg up. A lot of the companies, whether they be large cap or small cap, lag. Then the larger caps catch on, often as proxies to gold exposure, but then the small caps start to catch on. And we are now at the point where the small caps are starting to catch on. They're still underperforming a little bit, but I think the timing of this is pretty good. And it's all the things we talked about previously with the demand for gold globally, which is stemmed from quite frankly that global or the weaponization of monetary policy when the U.S. confiscated Russian assets for the invasion of Ukraine. That was an unprecedented event and caused many countries to start looking for a new reserve asset beyond just treasury bills in U.S. dollars. And that's when the gold buying started, and it started from flowing from west to east, bought in London and then delivered to Shanghai. And that is a persistent process that continues to occur. I would say that this bullish trend in gold has lots and lots of legs, and starting to think about legging into the stock side of it here, in particular, making sure you've got some mid caps in there is a good idea. So yeah, I'm thumbs up on GDXJ.
Thanks.
Oh, and silver. So silver, he asked about silver. Yes, silver is a levered play on gold, and it's a levered play on the economy. So remember my market commentary at the outset. If we're right and there's a positive right tail, i.e. things go better than we expect, silver probably explodes higher, starts to outperform gold and catches up with gold. So you can look at SLV as one of the largest Mac Daddies, and then there's some silver ETFs as well, but I'll stop there for now.
Okay, let's head to Eric in Montreal. Go ahead, please.
Hey, and thanks for the opportunity. I'm looking for suggestion for the Mac 7 or the high-tech high flyers in the States. Also, I will appreciate if you have any version in Canada, hedge version. And I looked at from Evolve, there is a product called ticker symbol is TECH, tech, but it seems to be the asset under management very light, extremely light, and then volume traded volume almost non-existent. So looking for suggestion. Thank you in advance. Have yourself a great day.
So there is an Evolve QQQT. I'm not sure if we have the chart for that. And then QQQY as well. What are your thoughts, Mike? Mag 7 ETFs, it would seem like an obvious idea, okay?
Yeah, well, there's the Defiance. Yes, there is. It's the Roundhill ETF. I just have to look it up. I'm sorry. MAGS, M-A-G-S.
Okay, MAGS.
It's the Roundhill Magnificent 7 ETF. If that's what you're looking for, then that delivers 29 basis points, and it is the MAG 7. So MAGS, that one trades in the U.S. So that's what you want, then that's what it is.
Okay, let me just see how that one has done over the past year. So for this year, well, certainly, let me give you the past 12 months on the MAGs, and it's up 34% in the past year.
Let's note the decline into the tariff day and Liberation Day.
Yes.
So I will recall this was a top pick I had back in January, and it was just for that. You know, if you're looking for something to get focused exposure to those large mega cap names, this is a way to do it. It came with a pretty significant drawdown along the way, but it does expose you to those 7 names.
Thank you very much indeed for that. We're going to be back with Mike Philbrick taking your questions on exchange-traded funds. We've got Ted in Toronto. Go ahead, please.
I have a small initial investment in XLF. And I'm wondering, is this a good time to start building it up higher?
Right, the financial services ETF.
Yes, and this is the financial select sector SPDR ETF, one of the larger sector ETFs covering that financial sector in the U.S. And I would say that given our thesis on the market, that yes, this is something that you can build on. You're seeing the financials starting to perform. We're at sort of highs for the year. So I would say yes, this is a very good ETF for that broad exposure. 8 basis points in fees, very liquid. So not a lot of cost to hold it, and it trades very efficiently. And if that's what you're looking for, yes, continue to build into that position. You do have the U.S. dollar exposure there, so we've talked about that. U.S. dollar probably continues to weaken vis-a-vis the Canadian dollar, so you might see some losses due to the currency exposure, but the sector in U.S. dollars remains very good, strong, and should do well.
Let's head to Richmond Hill, Ontario. Ed, go ahead, please.
Hi, thank you for taking my call.
Pleasure.
First-time caller here.
Good.
I am currently investing in VTI.
What was that? Sorry, Ed, what was that?
It's VTI, Vanguard Total Index.
Okay, sorry, yeah.
Now, the problem that I'm trying to solve is that VTI is potentially subject to estate laws in the United States for Canadian investors. So I'm trying to bring that money home and try to avoid the problem. And my research led me to XUU.EU, listed on TSX. My question is this the right approach for the given problem? Am I overthinking? And what's the right path forward?
Thanks.
There's a few paths forward. So remember, we did talk about this earlier when the caller asked about U.S. ETFs versus Canadian ETFs, and the caller hits on the exact point of there can be some state issues. That number is quite large, though. I think it's over $10 million of an estate before that kicks in. But you have many options, right? So you can the Vanguard. You're already in a Vanguard product. VFV is the Vanguard S&P 500 index. With a 9 basis point fee, and basically giving you that same exposure. The iShares Core S&P US Total Market is great too. 7 basis points there. It is just dependent on what way you want to go. with that. So the total stock market, again, right, so that's not the S&P 500, that's broader than that. So the caller is bang on. Your research is correct, sir. That is the right substitution.
Okay, we have Rolly in London. Go ahead, Rolly. Oh, I'm sorry, Rolly, we'll have to get you next time. I'm sorry about that. We're out of time for calls. My apologies, Rolly. We've got Mike's top picks coming up next. On Market Call tomorrow, our guest is Andrew Pyle, Senior Advisor and Senior Portfolio Manager at CIBC Wood Gundy. North American equities are the topic. And if by some weird mischance you missed Market Call, that would never happen. Check out our daily podcast. It's on iHeartRadio and other platforms. And we have full episodes on our YouTube channel. Let's get to Mike Philbrick's top picks. We're going to kick off here with the Vanguard FTSE Developed All Cap X US Index ETF. So it's a global equity play without America?
Correct. I thought I'd give all the Canadians out there an elbows up moment to cut not only California wine out of their diet, but U.S. stocks out of their portfolio. Just having some fun there. But yes, this is broad exposure to the world, X the United States. And we've got valuations between those developed international markets vis-a-vis the U.S. at relative value opportunities that have historically haven't been seen before. So very wide valuation differences. And you've got particularly in Europe and Japan. And so with this signs of improving economic momentum, and if we just look at VDU versus a U.S. ETF like the XUU, the last caller was talking about, probably going to see that these ex-US companies are actually outperforming the US. And so we've also got that diversification aspect that comes along with this, as Canada has deep economic ties with Europe and Japan. And so as supply chains reorganize themselves, this is going to be interesting. You have lower valuations outside of the U.S. than you do inside the U.S., so that is a potential opportunity to catch up. Plus, you've got that intentional weakening of the U.S. dollar. Again, another opportunity for these stocks to perform well versus their U.S. counterparts.
Okay, your next idea is a gold play, BMO Equal Weight Global Gold Index ETF. So this would hold big gold mining shares.
Yes. So we have to separate the difference between owning gold. When you own ETFs that own physical gold, that's just gold. You're getting that beta or that source of risk in return. Mm-hmm. When you layer that on top with equities, now you're getting an equity beta in the mix. So that can give you some gearing or leverage to the gold price, both upward and downward. Mm-hmm. But as we've covered, gold is a historical value, a historical hedge during periods of heightened geopolitical risk. Central banks remain buyers of gold. So we think the price of gold tends higher. And as we talked about before, we're in that period where now it starts to make sense to own gold companies because they're going to get leverage to the gold prices through their operations. And we want an equal weight because the large caps tend to have less leverage than those mid and small caps. And I like an equal weight because you get those chunky, juicy mid caps, less exploration plays and more development plays. So a little bit more certain. And so that's why the equal weight approach. And I think that offers a good diversified way to start entering into this area of the market for gold stocks.
Yeah, it's interesting. I'm just looking at the top holdings, kind of outdated information from BMO here. Maybe I'm looking at the wrong page, but as of the end of 2024, it didn't have the big global miners in the top holdings, Orla Mining, SSR Mining, Torex Gold, but it does try to keep it all equal, 3 or 4%. Correct. Yeah.
So what happens in an equal weight is those juniors or those mid caps outperform and they become 3.2% and they kick the seniors down to 2.9%. So they don't show up on the top 10. But that's exactly what we want. That's the performance we're looking for. We'll keep these big ones in there. We just want them at not market cap weight. We just have them at equal weight.
Okay. Finally, we're tight for time. The Fidelity Advantage Bitcoin ETF, FBTC in Toronto.
Yep. Yeah, and so I've been on talking about Bitcoin for a number of years. In Canada, you've had the ability to buy an ETF with Bitcoin in it for many years, more than the US. Those products had higher fees, though. So again, Bitcoin is becoming the new digital gold. It has that finite amount being produced. 95% of Bitcoin has been produced, but it's not in 95% of portfolios. This is an asset that has some asymmetric upside. And now you've got Fidelity offering this Bitcoin ETF at 36 basis points. This really kind of shakes the market up in Canada as a low-cost provider. You don't have to worry about wallets and coins. You can just buy it in your account. And I think this is a lot like gold, the new digital gold. It's going to become a reserve asset. The U.S. is talking about a Bitcoin reserve. Several countries in the world have already adopted Bitcoin as a reserve asset, and it's much smaller than gold.
Thank you very much indeed. Really appreciate it. Mike Philbrick. We're out of time on a market call. Have a great day in the markets.